Welcome back to InfluVestor. Over the past 40 days, we've tracked 36 videos from 9 of the top financial creators on YouTube, investors with verified track records ranging from nearly 19% to over 35% annual returns. That's not speculation. That's documented performance that puts most hedge funds to shame. After crunching all that data, we uncovered 11 distinct buy recommendations. But here's what got our attention. 3 specific stocks kept appearing again and again across multiple creators. We're talking about investors who've collectively beaten the market for years, and they're all converging on the same names. Now, I'm not going to tell you which companies they are just yet. That would ruin the fun. What I will tell you is this. One of these stocks has a creator calling it a less expensive SpaceX. Another has been labeled the single best-led company in America by an investor averaging nearly 36% annual returns. And the third? A creator with an 18.8% track record says it's a super profitable enterprise trading at the bottom of its 52-week range. These aren't random picks from anonymous Reddit accounts. These are seasoned investors with skin in the game, putting their reputations on the line with every recommendation. And when multiple high performers start buying the same stock at the same time, that's a signal worth paying attention to. So stick around, because by the end of this video, you'll know exactly who is buying these stocks, why they're buying them, and whether the data actually supports their conviction. Let's get into it. All right, let's reveal our first stock. It's a company you definitely know, but the bull case being made right now might surprise you. We're talking about Amazon, ticker symbol AMZN. Now, Amazon is currently trading at 245 or 34, and it's been trending up about 1.6% over the last 30 days. Not explosive movement, but steady. The question is, why are some of the best-performing creators on YouTube loading up on this name right now? Let's start with Joseph Carlson from Joseph Carlson After Hours. This is an investor with an 18.8% verified annual return, consistently beating the broader market year after year. And his thesis on Amazon? It's not what you'd expect. He's not just talking about e-commerce or even AWS. He's making the case that Amazon is essentially a less expensive SpaceX. Let me show you what he means.
I think that's a good thing in the long term of the business. Meta is a super profitable enterprise. I think that this one's a buy. Amazon's one that's worked out well. I'm well in the green on this one. It is only 14% off of its highs. It's trading in the middle of its 52-week range. Amazon also, on a historical valuation, looks very cheap based off of its PE ratio. It's at the very bottom range of the past 5 years. The cash flows are non-existent. Amazon's going into the red based on its free cash flow. But if we look at Amazon and the strength of this company, all the markets that they're in, to me, it's like a less expensive SpaceX. They really have almost everything. They have a Starlink business like Leo. They have Zoox, which is robo-taxi. They have an enormous robotics business. Amazon has millions of robotics, and they're going into all sorts of different types of robotics. Amazon, of course, has their logistics. They have their retail business. They have the ad business. They have Amazon Prime Video, and on and on and on. I really just love all the levers this company can pull, all the ways that they can win. For me, it's a great long-term story. The valuation is attractive here. I think the company will go above $300 per share. So I rate this one a buy. We have Netflix. This one has traded down a lot from the highs recently. It's down 30.
Okay, let's unpack that because there's a lot there. Joseph is pointing to Amazon's Project Kuiper, their low Earth orbit satellite constellation that's designed to compete directly with Starlink. But he's also highlighting Zoox, Amazon's autonomous robo-taxi subsidiary, and their massive investments in warehouse robotics. This isn't your grandfather's Amazon thesis about selling books online. Think about what he's really saying here. You're getting exposure to satellite internet, autonomous vehicles, and cutting-edge robotics, all bundled into a company that also happens to dominate cloud computing and e-commerce. And his price target? North of $300. That's more than 20% upside from current levels. But Joseph isn't alone on this one. Let's hear from Stealth Wealth Investing, a creator with an absolutely remarkable 35.7% annual return. When someone with that kind of track record speaks, you listen. His angle is a bit different. He's focused squarely on valuation. Here's his take.
Obviously, you guys have been out there doing the same exact thing. Great job by you guys buying a great business. And same goes for number one, and that stock is NVIDIA. And hey, I can't argue. NVIDIA has been just crushing it. They continue to destroy it. Obviously, Jensen has been, possibly the best CEO and the best 5-year run we've seen from a CEO in regards to performance in a long, long time. I hesitate to say ever because, of course, you can always go back through history and find significant things there. So I don't want to be kind of prisoner of the moment there. But hey, NVIDIA, oh, by the way, we're actually getting at a reasonable valuation there. I agree that the same growth that we were seeing prior is just basically impossible now, just due to the scale of numbers per se. It's just really, really hard to do. But it's a great company, a great stock. Obviously, they're one of the massive winners and massive leaders in the AI race there. So nothing bad to say about NVIDIA whatsoever. And we're getting it at a bit reasonable valuation. It's not like you're paying a 300 PE for NVIDIA. You're not. That's what.
This is a critical point that I think a lot of investors miss. Stealth Wealth is arguing that Amazon, despite being one of the largest companies on Earth, is actually cheap relative to its positioning in the AI revolution. We're not talking about a company that might benefit from AI. We're talking about a company that's already one of the dominant players through AWS and its AI infrastructure. And here's the thing. When you have a creator averaging nearly 36% annual returns telling you that a mega-cap stock is mispriced, that's not a claim made lightly. This is someone who has demonstrated over and over again an ability to identify value where others don't see it. But Stealth Wealth didn't stop there. He actually went deeper on why Amazon is his number 2 position in his entire portfolio. Let's hear his full breakdown.
Up and down in regards to Tesla. So there it is right there, Tesla. But coming in at number 2 is Amazon. I like Amazon marching up this list here. It's one of the ones that's still on a great valuation, still undervalued. Obviously, it's an incredible business. They have their tentacles kind of out there into everything. They're continuing to grow. AWS is just growing still. Obviously, they are leaning into the AI race their own way. They're leaning into robotics. They're leaning into the robotaxi. All those things, they're involved in everything. And there's no doubt in my mind that they're going to do it. They're going to do it well. Not everything is going to be this huge financial success, but I think they have enough fires in the iron per se. Several of those are going to print billions of dollars for them into the future there. Obviously, just Amazon itself, just their core business is so strong, so good. Their lead just continues to grow every year in regards to their core business there. So obviously, I love this business. I love the stock. We are getting it at a very reasonable valuation right now. I've been buying up shares. So obviously, you guys have been out there doing the same exact thing. Great job by you guys buying a great business. And same goes for number 1.
So let's synthesize what we just heard. Stealth Wealth is making a multi-pronged argument. Amazon is undervalued on traditional metrics, AWS continues to grow at an impressive clip, and the company's diversification into AI and robotics provides multiple paths to future earnings growth. This isn't a one-trick pony. It's a conglomerate of high-growth businesses trading at what he considers a discount. When you combine Joseph Carlson's less expensive SpaceX thesis with Stealth Wealth's valuation argument, you start to see why multiple high-performing creators are converging on this name. They're not just buying Amazon for what it is today, they're buying it for the optionality of what it could become. Now, I want to be clear, this isn't investment advice. Every investor needs to do their own due diligence. But when creators with 18% and 35% annual returns are both pounding the table on the same stock for complementary reasons, that's the kind of signal that's worth investigating further. Before we move to the next stock, a quick heads up. If you want these alerts in real time, join our free newsletter in the pinned comment. You'll get instant notifications whenever these top-tier creators recommend a stock, plus monthly deep dive reports just like this one to maximize your investment returns. Don't wait for the algorithm. All right, let's move to our second stock, and this one has been at the center of arguably the biggest investment theme of the decade. We're talking about NVIDIA, ticker symbol NVDA. NVIDIA is currently trading at $210.96, up about 3% over the last 30 days. Now, I know what some of you are thinking. NVIDIA? Hasn't that ship already sailed? After the massive run-up we saw, it's a fair question. But here's the thing. Some of the best-performing creators on YouTube are saying the exact opposite. They're arguing that despite the gains, NVIDIA is actually cheaper now than it was a year ago. Let me show you why. Let's start with Stealth Wealth Investing again. Remember, this is the creator with a 35.7% annual return. His take on NVIDIA centers on one person, Jensen Huang. Here's what he had to say.
Obviously, you guys have been out there doing the same exact thing. Great job by you guys buying a great business. And same goes for number 1, and that stock is NVIDIA. And hey, I can't argue. NVIDIA has been just crushing it. They continue to destroy it. Obviously, Jensen has been, possibly the best CEO and the best, 5-year run we've seen from a CEO in regards to performance in a long, long time. I hesitate to say ever because, of course, you can always go back through history and find significant things there. So I don't want to be kind of prisoner of the moment there. But hey, NVIDIA, oh, by the way, we're actually getting at a reasonable valuation there. I agree that the same growth that we were seeing prior is just basically impossible now just due to the, scale of numbers per se. It's just really, really hard to do. But it's a great company, a great stock. Obviously, they're one of the massive winners and massive leaders in the AI race there. So nothing bad to say about NVIDIA whatsoever. And we're getting it at a bit reasonable valuation. It's not like you're paying a, 300 PE for NVIDIA. You're not. That's what.
This is such an important point that often gets overlooked in the valuation debate. Stealth Wealth is making a direct comparison to Tesla, which has traded at PE ratios north of 300 at various points. His argument is simple. If the market is willing to pay that kind of premium for Elon Musk's leadership at Tesla, why wouldn't it pay a similar premium for Jensen Huang at NVIDIA, a CEO who has arguably executed even more flawlessly over the past several years? And let's be real about Jensen's track record. He saw the AI revolution coming years before most people even understood what a GPU could do beyond gaming. He pivoted NVIDIA's entire business model, invested billions in data center infrastructure, and positioned the company as the picks and shovels play of the AI gold rush. That's not luck. That's vision combined with execution. But the bull case doesn't stop at leadership. Let's hear from Dividend Data, a creator with a 19.7% annual return. He breaks down the actual numbers behind NVIDIA's business, and they're staggering.
Is by analyzing the specific companies that make up the ETF or index. So let's look at NVIDIA as an example. This company's up 43% over the past year, but there is real actual earnings backing that up. As an example, over the trailing 12 months, their earnings per share is up 83% year over year. So there's real earnings growth backing that up. And in fact, the earnings growth rate is far exceeding the stock price growth for NVIDIA. And this isn't just earnings, it's free cash flow. Their free cash flow is up 65% year over year. And they just hit an all-time high in the latest quarter, just under $50 billion in quarterly free cash flow. And this is not expected to slow down anytime soon. So NVIDIA stock today is actually far cheaper than it was a year ago. The valuation metrics look more attractive now. So in stocks like this, I think the market is actually quite attractive and there's many opportunities I see. And if you haven't noticed, NVIDIA, that's one of the companies I've gone heavy on in 2026, and I plan on owning for the next couple years. However, it's kind of unpredictable what's going to happen in the AI trade.
Let those numbers sink in for a moment. 83% year-over-year earnings growth, $50 billion in quarterly free cash flow. And here's the kicker that Dividend Data emphasizes. Despite all the gains, the stock is actually cheaper now than it was a year ago on a forward earnings basis. How is that possible? Because earnings have grown even faster than the stock price. This is a concept that trips up a lot of investors. They see a stock that's doubled or tripled and assume it must be expensive. But if earnings have tripled as well, the valuation multiple might actually be the same or even lower. That's exactly what's happened with NVIDIA. Now let's get one more perspective. Joseph Hogue from Let's Talk Money is a CFA, that's a chartered financial analyst, with a 22.8% annual return. He brings a more technical, margin-focused analysis to the table. Listen to this.
Just all going to be writing a check to Jensen Huang every April, like we do with our taxes, because this company is going to control everything. Revenue growth is expected to continue its AI-fueled pace at 61% over the next year, a slight slowdown from the last year, but still well over that 5-year average. And what makes this a can't-miss stock, though, is its profitability. While other chip makers are spending heavily on R&D and marketing just to catch up with this company's edge, NVIDIA is able to charge customers premium pricing on its tech. That translates to a 65% EBITDA margin, that core operating profitability, more than 3 times higher than the profitability at AMD and even the 54% margin we see on Broadcom. On that adjusted valuation, NVIDIA's relatively modest 34 times price-to-earnings valuation looks even cheaper with its 61% expected earnings growth. And while there's still one more stock cheaper here, I think NVIDIA has by far the more durable earnings growth, and I'd put this on top of my list of stocks to buy. And before we see that best deal in AI stock.
3 times AMD's margins. Let that sink in. NVIDIA isn't just winning the AI chip race, They're winning it with a business model that generates dramatically more profit per dollar of revenue than their closest competitor. 65% EBITDA margins in the semiconductor industry is almost unheard of. That's the kind of pricing power that comes from having a product that customers literally cannot do without. And Joseph Hogue ranked NVIDIA as his top stock to buy. This is a CFA with a nearly 23% annual return, putting his reputation on the line with that call. Combined with the 61% expected earnings growth he mentioned, you start to understand why multiple high-performing creators are still bullish despite the run-up. So let's bring this together. We have Stealth Wealth arguing that Jensen Huang's leadership justifies a premium valuation. We have dividend data showing that the stock is actually cheaper than it was a year ago despite the gains. And we have a CFA highlighting margins that are 3 times the competition. 3 different creators, 3 different analytical approaches, all arriving at the same conclusion. NVIDIA is a buy. Again, this isn't investment advice. NVIDIA carries its own risks, competition from AMD and custom AI chips, potential demand slowdowns, regulatory concerns. But when you have this level of consensus from creators with verified track records, it's a data point that deserves serious consideration. All right, let's get to our third and final stock, and I have to say this one might be the most controversial pick of the bunch. We're talking about Meta, ticker symbol Meta. Meta is currently trading at $660.21, and it's been on a tear, up 17.8% over just the last 30 days. Now, Meta has always been a polarizing stock. Mark Zuckerberg is a polarizing CEO. The metaverse pivot was polarizing. The massive Reality Labs losses were polarizing. But here's the thing. The creators we track aren't interested in narratives. They're interested in numbers. And the numbers on Meta are telling a very interesting story. Let's start with Joseph Carlson from Joseph Carlson After Hours. Remember, this is an investor with an 18.8% annual return. His analysis of Meta is refreshingly balanced. He acknowledges both the bull and bear cases. Here's his breakdown.
For me, it's still a great company. I'm still going to hold it, but I'm not piling more money into ASML at 3% off of its highs. Next up, we have Meta. Meta is 27% off of its highs. That's quite a sell down. It's towards the bottom of its 52-week range, under the 5-year historical valuation. Like many of these hyperscalers and big capex spending companies, Meta looks cheap on a PE ratio and looks expensive on a free cash flow yield, because every nickel and dime that Meta's making is going towards capex, just like with Google, just like with Microsoft and Amazon. All these companies are spending basically every dollar they make on building out more compute infrastructure. I think that's a good thing in the long term of the business. Meta is a super profitable enterprise. I think that this one's a buy. Amazon's one that's worked out well. I'm well in the green on this one. It is only 14%.
I want to highlight something important in Joseph's analysis. He's being intellectually honest here. He says Meta looks cheap on a PE basis, but more expensive when you look at free cash flow due to the massive capital expenditures. That's the kind of nuanced analysis that separates good investors from great ones. But despite that caveat, he still rates it as a buy. Why? Because he calls it a super profitable enterprise. And he's right. Meta's core advertising business is an absolute cash machine. The question is whether the investments in AI, the metaverse, and other moonshots will eventually pay off. Joseph is betting they will. Now let's hear from Stealth Wealth Investing. And I want to set this up properly because Stealth Wealth actually starts by acknowledging the elephant in the room. A lot of people just don't like Mark Zuckerberg. Here's how he addresses that.
What a performance from a company, but it's still too expensive for myself to make it on the list this time. But let's move on to the final stock on this list, and it's going to be Meta. Hey, look, I know it's not everybody's favorite. I understand that completely. I understand a lot of folks don't like Zuck. Totally understand. A lot of folks don't think they know what they're doing over at Meta. Totally understand. A lot of folks want to point at the metaverse and say it was a mistake. I would agree there 100% completely. But to say this guy doesn't know how to lead a company into just printing money is factually false. To say he can't learn from his mistakes is just a giant assumption that's based upon nothing. And more importantly, they seem to be putting money into the right areas, and they seem to be chasing other parts of AI that fit more with their overall strategy in regards to both software and hardware and a lot of other things of that nature. They seem to be on a much better track this time of doing their own thing, not chasing what everybody else is chasing, but chasing their own thing. Yes, they're
This is such a crucial point for investors to internalize. You don't have to like a CEO personally to recognize their ability to generate shareholder value. And Stealth Wealth's argument is simple. Whatever you think about Zuckerberg as a person, his track record of printing money is factually undeniable. Facebook, Instagram, WhatsApp, he's built or acquired some of the most profitable digital properties in human history. But Stealth Wealth doesn't stop there. He goes deeper on why the current moment represents a buying opportunity. Let's hear his full bull case.
but I believe it's part of a bigger holistic picture that they're not necessarily letting us in on yet. Even if that's not the case, okay? They still print money. The core businesses are still printing money. They're still growing double digits. This is an incredible business. We saw it. He burned money on the metaverse. Didn't freaking matter long term at all. Didn't matter. Who freaking cares? Meta was right back to printing huge, huge EPS numbers and, of course, giving us massive returns as investors. So this one right here, again, seems to fall out of favor. It seems like every other year or so. Great. It's out of favor right now. Please continue to beat this down so I can continue to add to a great stock like Meta at cheap valuations. And remember, if you want to see my complete watch list with price targets, you want to learn how to do valuation so you know exactly.
This is the contrarian playbook in action. Stealth Wealth is pointing out that the metaverse losses that everyone panicked about, they didn't actually matter in the end. Meta's core business was so strong that it absorbed those losses and still bounced back to massive EPS numbers. And now, with the stock out of favor with certain investor segments, he sees a buying opportunity at what he considers cheap valuations. Let's think about what's happened with Meta over the past couple of years. They went through the year of efficiency, cutting costs dramatically. They refocused on their core advertising business. They've become one of the leading players in AI, with their Llama models competing directly with OpenAI and Google. And through it all, the advertising revenue kept growing. When you have a creator averaging 35.7% annual returns, telling you that a stock is cheap because it's out of favor, that's worth paying attention to. Markets are driven by sentiment in the short term, but fundamentals win out over the long term. And Meta's fundamentals, the user base, the engagement, the advertising efficiency, the AI capabilities, remain exceptionally strong. So let's synthesize the Meta thesis. Joseph Carlson sees a super profitable enterprise trading near the bottom of its 52-week range. Stealth Wealth sees a CEO with an undeniable track record of generating shareholder value, with the stock trading at cheap valuations because it's out of favor. Two different creators, two different approaches, same conclusion: Meta is a buy. All right, let's bring this all together. We've just walked through 3 stocks that multiple high-performing YouTube creators are buying right now: Amazon, Nvidia, and Meta. With Amazon, we heard Joseph Carlson's less expensive SpaceX thesis, highlighting the optionality in satellites, robotaxis, and robotics, combined with Stealth Wealth's argument that it's a cheap way to play the AI revolution through AWS. With Nvidia, we saw consensus around Jensen Huang's exceptional leadership, the mind-blowing 83% earnings growth and $50 billion in quarterly free cash flow, and margins that are 3 times the competition. And with Meta, we heard the case for a super profitable enterprise, led by a CEO who, love him or hate him, has an undeniable track record of generating shareholder value, now trading at valuations that multiple creators consider cheap. Now, I want to be crystal clear. This video is not investment advice. Every single one of these stocks carries risks. Amazon faces competition in every segment. Nvidia could see demand slow or competition intensify. Meta's investments in the metaverse and AI might not pay off as expected. You need to do your own due diligence before making any investment decisions. But here's what I find valuable about this approach. We're not relying on anonymous tips or unverified claims. We're tracking creators with documented, verified track records, investors who have beaten the market consistently over multiple years. When multiple high performers converge on the same names, that's a signal worth investigating. So here's my question for you. Which of these 3 stocks are you most bullish on? Amazon with its diversified moonshots, Nvidia with its AI dominance, or Meta with its advertising cash machine? Drop your thoughts in the comments below. I read every single one, and I'd love to hear your perspective. If you found this analysis valuable, make sure to subscribe and hit that notification bell so you don't miss our next deep dive. And remember, If you want these recommendations in real time before they hit YouTube, our free newsletter link is in the pinned comment. Thanks for watching, and I'll see you in the next one.